Hi, and thanks for joining me for the January edition of Monthly Market Mail. Again, my name is Matt McGrath, managing broker and one of the housing coaches here at Capstone Real Estate. Let's go ahead and jump right into the report. The monthly market mail updates will consist of both a look back at the marketplace, an examination of the current market, as well as forecasting market trends into the near future. So first, let's take a look at the existing home sales. And I want to separate some fact and fiction because there's some fairly misleading headlines out there right now, and I want to make sure that you understand what those headlines really mean. When the December Case-Shiller report came out, CNN Money put this headline on their website: "Home prices jump 13.6%." Wow, that sounds great. Maybe even a little bit scary. Some are going to be reading this and saying, well, if home prices are jumping, maybe I should wait before I sell my house and get more for it. And some buyers would be looking at this saying, well, if home prices spiked like that, maybe there's another bubble that's going to burst and I should wait because prices are going to come down again. Well, then they're going to go ahead and really get confused because they're going to look at the headline from the LA Times. Now, this was on the same day, and they were reporting on the same report, but giving a totally different understanding. Home prices increase slow. Well, let's go ahead and look at the existing home sales report and see what it really says. Existing home sales have fallen off during the winter season, and that's to be expected, as it does in every normal market. But not everybody understands that. The last existing home sales report, the December report, showed the existing home sales were down year over year for the first time in 29 months. It's almost 2.5 years. And there's a number of other headlines out there. Of course, you got to go to the headlines that are saying, well, the market's starting to crash again. And there's people saying, well, the interest rates are going up, so less people are buying. And still others are saying, well, there's not a lot of consumer confidence in housing right now, so they're deciding not to pull the trigger and stay up on the fence. Well, let's go ahead and take a closer look at that report. Now, here's a map of the year over year, the percentage of change by region. Now, this is the same report, only broken down regionally. And what we can see is in the Midwest, a number of states were unchanged year over year. In the South, they were up a little bit. In the Northeast, they were up over 6%. So in two-thirds of the country, the number of sales year over year were actually up and not down. Now, in the West, they were down and down rather dramatically by 10%. But now the reason for that, the reason that they were down in the West was because there was no inventory. There's a tremendous lack of inventory in many of the hottest markets there, whether it be in Phoenix or in Tucson, San Diego, San Francisco, and so many others. There's a shortage of inventory there. So they can't do more sales because they don't have the available listings. Now, if it was an issue of interest rates, we would see the year-over-year percentage change be very similar, a very similar fall off across the whole country, because the interest rates impact the whole country. If it was a lack of consumer confidence, then we would see the same type of fall off again across the whole country with very little variance. But what we're seeing now is one coast is up 6%, the Northeast, and the other is down 10%. Now, that's got nothing, or at least very little, to do with interest rates, very little to do with consumer confidence. As a matter of fact, the last pending home sales report was actually up. You see, the pending sales are a precursor to what's going to take place in the existing home sales report in about 60 days. So the fall off in the existing sales, we can see the rationale there. And with the pending home sales, we can conclude that the market is continuing to recover. So we expect a decent winter, despite all of the cold weather everywhere, and we expect a very strong spring. We'll take a look at the forecast in just a bit. Right now, though, we're going to take a look at the inventory levels, more accurately the absorption rate, or the month's supply of inventory. When we have big price gains, it's because we have more buyer demand than seller supply. When the market was in the tank, it's because we had a huge amount of inventory and very little buyer demand. What we've seen from 2013 is a normalization. Typically, when you have less than a 5-month supply, it's a seller's market. And when you have more than a 6-month supply, it's a buyer's market. That 5 to 6 month supply in the marketplace indicates a relatively healthy and even marketplace. At the beginning of the year, inventory was well below that 5-month threshold, and right now we're bouncing back and forth off that 5-month supply. As demand increases dramatically in 2014, that number is going to drop substantially, unless, of course, we see an uptick in people hopping off that fence. And really, it's time to do it if they haven't already. As, as we're going to see shortly, both prices and interest rates are going to be on the rise. So it's an excellent time for a move-up buyer to sell their current property and find that next home, which I'll expand on in a bit. But even if you had to take a little bit of a loss on your current sale, which fewer and fewer people are having to do right now, you'll make up for it with the appreciation on a larger home and the cost savings of today's lower interest rates. Now, here's a great look at the market bubble overall, and you can see in the trend, the 20 city composite, that pricing trends are on a definite uptake, indicating a more sustained market recovery. One of the reasons for that recovery is that the percentage of distressed properties dropped to more than half, from 35% back in January 2012 to 14% now in January 2014. The percentage of distressed property sales dropped to more than half. So now let's look at the local market. That's really what's going to have a direct impact on us here in the Chicago area. The health of the marketplace nationwide gives us an idea of what we can expect, at least if we look behind the headlines like we just did. But our market here in the Chicagoland area isn't like the West Coast or the East Coast. In fact, if you ask me how the market is, I have to say, well, it all depends on where you live. I mean, experience shows that the market conditions vary from state to state, city to city, and even neighborhood to neighborhood. But just as looking at the national marketplace gives us some insights to our local marketplace, looking at the overall Chicagoland marketplace will give you some insights to your neighborhood. First, a broad overview. Looking at the northeastern Illinois area, we can see that there's a wide range of market conditions, and not all is appreciating. Now, here in Chicago, in the Chicagoland metro area, we're doing pretty well overall, up 9.5% versus this time last year. However, the Rockford area is down 1.7%, and the Kankakee area is down 5.1%. But let's go ahead and dive a little bit deeper into the Chicago metro area. And I'm going to shift over to our MLS data so we can get some more specific data where we can see some clear trends. Now, as we look at the entire MLS coverage area, which is a bit broader than the earlier Zillow data, we can see an overall increase of 9.7% in median home sale values year over year, comparing 2013 to 2012. Now, the graph below identifies 2012 as the real bottom of the market, and the beginning of the current recovery. Now, this data includes all property types and all sale types, such as new construction and resale, foreclosure, and distressed home sales as well. And you can see that we're still quite a ways off from where we were in 2008, when we really just started beginning to free fall. Actually, let's go back to Zillow real quick so we can see a little bit further back and compare today's values with the values of the peak of the market before the fall. Here you can see we peaked in November of 2006 with a median sales price of 244,000, and you can compare that with the 178,000 for today, or the 170 from the other example before, from the entire MLS. Another important trend to look at is the time on the market. This is reported in the number of days it takes to sell a property. Currently, it's down to 112 days from 151 back in 2012, which is a reduction of about 26.3%. Now, here's another great indicator of improving local market trends. Remember we talked a few minutes ago about inventory levels? Well, as we look at the local inventory levels and the history going back to 2009, that topped us out at 15.6 months supply of homes. Now we've steadily decreased down to just 5.1 months supply today. Now, below the video, I have additional breakouts for the Chicagoland counties. Most of the trends mirror what we just saw here for the entire area. However, if you broke this down even further and compared different cities and villages in the area, you'd see that there even further demonstrations that the marketplace is hyper local. Now, I want you to please feel free to contact me using the form at the bottom of the page to request market report for your city or village. It would just take way too long to break through it on the video here. So this kind of wraps up our look at the previous market data and the current trends. Now let's start looking forward so we know what to expect as we head into 2014. Everything we looked at so far has been showing various trends. We've seen where we were and where we are now, which establishes a basis for looking ahead and anticipating an outcome for the upcoming year and even a little bit further. As we just saw looking back at the housing statistics graphs for the area, we reached the bottom of the market. We could see that we reached that in 2012 as the recovery began. The market stabilized in 2013, and in 2014 we're expecting growth. And there's a few reasons for that. Let me share a few of those major reasons with you. First off, let's look at the economy. Okay, this graphic makes it look like we're skyrocketing, which isn't really the case though, but we are seeing some improvement overall. I'm including a data map from calculatedriskblog.com, and it's the November State Coincident Index 3-month change report. So is the economy doing better or worse? And in a second, we're going to talk about what this report is actually reporting on. But for right now, I want to just take a look at this map real quick. The states in the green are doing better. Again, not huge increases, but better. And I was actually surprised to see that Illinois is darker green, indicating over a 1% increase. We can also see that 46 of the 50 states are some shade of green, and that's showing some improvement, indicating across the country the economy is starting to come back. So what does that mean by starting to come back, and what does this map actually show? Well, here's the exact quote from the Federal Bank of Philadelphia, where the information was garnered from. The coincident indexes combine four state-level indicators to summarize current economic conditions in a single statistic. The four state-level variables in each coincident index are non-farm payroll employment, average hours worked in manufacturing, the unemployment rate, and wage and salary disbursements deflated by the Consumer Price Index. The trend for each state's index is set to the trend of its GDP, so long-term growth in the state's indexes match long-term growth in its GDP. Well, that's a really fancy way of saying if we take a look at the employment, look at the number of hours, look at the wages and salaries, and we look at the GDP, how much is the state producing? And we can see, looking back at that map, that across the country, the states are getting better. And the reason that's important is that as employment goes up or unemployment goes down, there will be more buyers coming into the marketplace. Now, I expect that this year, in fact, is going to be the year where the economy really starts to come back. No, not because of the current administration, but many have said that the economy was not going to come back until the housing market came back. And the housing market came back pretty well in 2013. So what can we expect if the economy does continue to grow? What kind of an impact will that have on housing? Well, number one, we're expecting that there's going to be a lot of repeat home buyers. That's the people that currently own a home, which are going to sell and move up, move down, move sideways. So they're going to move somewhere. They're going to move. As a matter of fact, Truly is calling for 2014 to be the year of the repeat home buyer. As prices have increased, more and more people are entering into a positive equity position. Once they're in a positive equity, they now can go ahead and sell their home without bringing money to the table or without short selling it and impacting their credit. So there's a pent up demand for people currently living in homes that want to make a move, and they just couldn't do it over the the last couple of years. And we believe very strongly that this is going to be a major part of the marketplace and is going to be driving the market forward as we move forward into 2014. The second thing that's coming up on us, and I'm not going to talk politically, well, not in the update anyway, but there's going to be some talk about immigration reform. And it appears as though we will have some sort of immigration reform. So let's talk about what that's going to mean to housing. In a study by the Bipartisan Policy Center just last month, that they said that if they do, if they take undocumented workers and give them some access to citizenship in this country, that the demand for housing increases as the new immigrants enter the economy and form households, will be accelerating the current housing recovery and fueling the growth in the sector of the economy. Now, there's going to be some ramifications elsewhere. I'm not debating that. But according to the study, if they do some sort of immigration reform, housing is going to be impacted by the sum of $68 billion a year. That's the projected annual increase in spending on residential construction. That's $68 billion. Now, some sort of immigration reform is probably going to pass. And depending upon how strong a reform it is, X amount of people are going to come into the market. X amount of people are living in this country now but are afraid to go ahead and purchase a home because they don't know if they're going to be allowed to live in the country tomorrow. Now all of a sudden they have a pathway to citizenship and they can feel comfortable. And if that happens, NAREP thinks that the number of people that might form a new household and purchase a house is up to as many as 3 million families. And lastly, another pent-up demand for housing is the Millennial Generation. Right now, there's 121 million households in the United States. And the Urban Land Institute, in their Emerging Trends in Real Estate for 2014, has projected a growth over the next 3 years is going to be in the neighborhood of 3.7%. Now that's almost 4.5 million new households that are going to be formed. People moving out of their parents' home, people getting married, having kids and buying a house or renting an apartment. People getting out of college and getting a good job and forming their own household. On average, that's going to be about 1.5 million a year. Now, that's not to say that they all will or even should be buying a house, but many that can probably should take advantage of all that this market has to offer. But here's a quote from Christopher Herbert, the research director at the Joint Center of Housing Studies at Harvard University. It says, well, I think it's a basic question of supply and demand. When you have that many more renters coming into the market looking for housing, and the supply of housing isn't responding as quickly as it might, that's going to push rents up, even if incomes are low. Now, the Joint Center of Housing Studies at Harvard University, when asked the question where rents are going, says it's basic supply and demand. And there's going to be more households forming, more people coming into the market. The housing inventory isn't increasing dramatically, especially on the rental side, and that means prices are going to be driven up. As a matter of fact, Sean Donovan, the Secretary of Housing and Urban Development in the United States, said, we are in the midst of the worst rental affordability crisis that this country has known. With skyrocketing rents, it will make sense for as many millennials to choose to purchase as long as they know that they're going to be in the area that they're going to be staying in for some time. Here's something that's worth noting, especially after many are kind of licking their wounds after the market crash. According to the Federal Reserve, a homeowner's net worth is over 30 times greater than that of renters. That's kind of an important fact that we really need to share with not just the millennials, but anybody who's renting, because a lot of people just aren't aware of this. The average net worth of an American family that owns a home is $174,000, while the average net worth of a renter is a little over $5,000. Now that's huge. Anyone who's still wondering if they should own or rent, they really need to see this. Another factor that's going to be affecting the marketplace is interest rates. So let's take a little bit of a look at interest rates and the impact of increasing interest rates on the marketplace, because they will be increasing. Back in mid-December, the Fed did as we expected them to do, which is to announce that they would be cutting back on their purchasing of bonds. Now, this caused an immediate uptick in rates. They bounced up to 4.5 and have kind of settled back a little bit down to 4.25 right now. But that's a full percentage point over where the rates were last year. Bill McBride at Calculated Risk is saying now, after the government announced that they were going to start tapering in December, I think it's very likely that QE3, and QE3 is the actual stimulus package, uh, will be completed by the end of 2014. There are 8 meetings during the year, and I expect the Fed to reduce the pace of asset purchases by about 10 billion per meeting. It appears that they will only slow the taper if inflation declines sharply or if the economy stalls. I think both are unlikely. Now, what does that mean? 10 billion per meeting. Well, they're purchasing at about 75 billion now. If they reduce by 10 billion each of the 8 meetings, by the end of the year, they're going to actually put to bed that stimulus package. Again, that's a quote from Bill McBride, who's been guessing that right, calling that right from the beginning. So what's going to happen is the government removes the stimulus package that actually kept the interest rate at historic lows for the past several years. Interest rates are going to go back to more normal numbers. Here's what it looked like in 2013. They were keeping them low, and remember, moving up to September or over the summer, they had talked about the fact that they might raise the interest rates or taper the stimulus that would raise the interest rates by September. And as soon as, just from talking about it, interest rates shot up. Now, when they didn't actually do it in September, they fell off a bit, but now the tapering has started. And as it continues, we believe the blue graph is actually going to get higher and higher. And again, we believe that by this time next year, they're going to be about a full percentage point higher than they are right now. Well, let's forget about what we believe, and let's take a look at what the analysts believe. Fannie Mae and Freddie Mac haven't reported yet where they think the interest rates will fall for the first quarter of 2015, a year from now. So we couldn't put them on this graph, but we'll be putting them on this table next month. But the National Association of Realtors and the Mortgage Bank Association both project that interest rates are going to be just short of a full percentage point higher than they are right now. So if prices are going up and interest rates are going up, every potential home buyer is going to spend more money a year from now than they are right now. And if they take out a mortgage, which most of them will, they're going to be spending that over the next 30 years. And that's going to impact that family's net worth. Now, the other side of this is with interest rates going up, everyone's going to be talking about, prices are going to fall if interest rates go up. Well, here's a graph we pulled from KCM. They put it together with information that they got from Calculated Risk. It's a historical look back at what happened in the past when interest rates skyrocketed over a short period of time. And it happened 4 times over the last 30-something years. And what we can see in each one of those slides, if you go down to the bottom, you can see what happened to real estate values during that time, because interest rates are going up when the economy is going well. When things are going really, really well, what happens to home prices? They go up. Um, Now, interest rates shooting up will have an impact on the market. I'm not arguing that, but some people think that it's going to drive prices down. Well, let's go back on history. The last 4 times over the last 30 plus years that interest rates skyrocketed up, every single one of those 4 times, prices still appreciated. Now again, this will have an impact because it will affect affordability. If interest rates go up, then people can buy less of a house, and some people will be priced out of the market altogether. So it will affect buyers. As a matter of fact, Freddie Mac actually gave us some information on that. 70% of the country right now is affordable at the current interest rates. If interest rates go up to 5%, only 63% of the country will be affordable. And at 6%, 55% of the country. And at 7%, only 35% of the country. So what you can see here is that different interest rates, as interest rates go up, less of the country is affordable to a normal buyer. So will it have an impact? Yeah, it's going to have an impact. Now, Pulsenomics is the company that we get the home price expectation survey from. They're the people that go ahead and survey over 100 of the leading experts in the country. And recently they just asked them what mortgage rate would they deem a significant threat to the market, meaning at what point does the interest rate really have a major impact on the marketplace. And we can see that up until 6%, very few people, or on about an average of 13% of the people of those surveyed, those experts, felt that there would be some impact. But once we hit 6%, it's going to have a dramatic impact. That's the number that the experts think will be a significant threat to housing, 6%. If we're at 4.25 or a little over 4.25 now, and think that interest rates are going to go up a full percentage point over the next year, well, we're gonna have a great 2014. But based on what else happens in 2014, interest rates might be as high as 6% going into 2015. Now, people should be buying their house now, so we don't need to worry about this year, but we will have some concerns about that at the end of the year as we go into 2015. So as we examine the impact of rising interest rates on buyers' purchasing power, we can see how waiting will actually affect the final purchase price. Now watch carefully as we go through a few slides here. We included a number of incremental examples since we have such an economically diverse marketplace. So we can see if a home buyer is buying a $200,000 house, again, if you look all the way at the bottom right-hand corner of the slide there, the $200,000 mortgage, they'd be paying about a little bit over $1,000. And if they wanted to keep their mortgage payment at $1,000 as interest rates went up, they would actually have to buy less of a house to keep that payment around that $1,000. Here it is as 400,000. Now, waiting is going to do one of two things for, or should I say, to a home buyer. It's either going to drive their payment up, or if they're going to lock their payment to meet their budget at a certain level, it's going to force them to buy a less significant home than they could buy right now. And this goes for first-time home buyers as well as move-up buyers. Here's that example at 600,000. And here it is at 800,000. And just for fun, I threw this one in at $1 million. And any of you $1 million home buyers, give us a call. We're here for you. Lastly, I want to take a quick look at pricing forecasts from state to state. Actually, most economic forecasters don't report on a state-by-state basis. However, this map relates the Realtors Confidence Index survey, where they actually are talking to realtors about what they think will be happening to prices in their state. And that's exactly what this map shows. Those in the dark green states, they think they're going to be over what most experts are projecting, about 4 to 5% increase nationally next year. The medium green states are going to be between 3.3 and 4.1% of an increase in price, and the lightest green are going to be anywhere from 0 to 3.2%. So we could take a look at it, and as far as the real estate agents in the marketplace are concerned, prices are going to be going up across the whole country. And in some parts of the country, they're going to be going up rather substantially. Now, again, this is a survey of real estate agents, people with, dare I say, boots on the ground. no, I shouldn't. More like butts in a car. but there are some definite pros and cons to this. We as an industry are a little emotionally involved in the outcomes, and I understand that. But we're also the ones in the field day in, day out, feeling the impact and experiencing the opportunities as they present themselves. We are the people closest to what's really taking place. So that's it for this edition. I know that was a lot of information. Feel free to go through it again or refer back to it later. And if you have any questions, give me a call or send me an email. I will be preparing a full update like this every month, and you can expect the updates toward the end of the second or beginning of the third week as the numbers become finalized for the month before. And if you're thinking about making a move, call me, send me an email, and I will get you a specific breakdown for your community. And know that we are here to serve. So put us to work. If you are considering a move, start by requesting a no cost, no hassle consultation. I am a realtor, but I look at my job more as a coach or a consultant. I educate and I guide my clients or prospective clients, and I never use high pressure sales techniques. Let's talk. Give me a call or request your consultation on our site, and I look forward to being of service.